Good morning, everyone. We just thought of discussing the pre-scene, and finally we will be moving on to discuss the recent past paper 2020 for December past paper for SL2. And apart from that, if you have anything that you want me to clarify, we can clarify that as well. Okay, so that was the main purpose of hosting the session today. Right. And we will just look at the key points given in the pre-scene, and let's try to figure out the most examinable area in the syllabus by just going through the pre-scene. Sometimes you can see the paper, unseen paper being connected to the pre-scene, but sometimes there is no connectivity between the pre-scene and the paper. I mean, there is hardly a connectivity. So the information given in the unseen will be independent from the pre-scene, so that's a weakness in this concept. So last time it was not connected so much. We wish this time the paper will be connected to the pre-scene. I hope this time the paper will be a little easier than previous time. Okay. Now you know what this group is. The real company was Dialog, but this Dialog real company has been replicated into a different name called STL. STL. And we try to find out certain strengths and weaknesses in the company, basically the strengths in the company. And those strengths of a company will be important, especially for the valuation question number 3. Okay. I think almost everyone would have gone through enough times the pre-scene. If you have gone through the pre-scene, what do you think are the strengths in this company? What are the strengths in the company? Can somebody say, please? The strengths of the company. And this company has been started in 1999. We are now in 2025. This company has a history of at least 25 years. A company having a long history of operations is very important in finance management, in terms of finance management. Why? Yeah. Yes. The company is the market leader. The company having a history, a long history is very important, especially for a question like valuation, because for you to decide the growth rate in the future, it can be the growth rate of the future cash flows, it can be the growth rate of future dividends. For us to set the future growth rate of dividends and the future cash flows, so we need to have information, we need to have statistics. So where do we take that information from? Where do we take that statistics from? We will take them from the history. Now if you go through, they have given some statistics, and you can see the dividend paid in the very first year, 99, and the dividend paid in the previous year. So thereby you can work out what dividend growth rate. A company having a history is an important, a predominant strength in a company, a long history. So let me just jot them down. Long history. Okay. I recommend that you jot them down, because it will be important for you at the exam. Sometimes the examiner will be asking direct questions from this area. Will be asking, now you know, if you apply the dividend growth model, you cannot apply the dividend growth model if the company does not have a history. Why? You do not know how the dividends have been growing in the past. So without you knowing how the dividends were growing in the past, so how do you predict the future dividend growth rate? Very difficult. Very difficult. So a company having a long history is a very strong point. Second, this company is a listed company. Listed company. And the company was listed in which year? 2019, as far as I can remember. Why is that? A company being a listed company is an important strength, because it's very easy to value a company, and you have learnt in the theory lessons the minimum guaranteed value of a company which is not listed should be the balance sheet value. Minimum guaranteed value of a company should be the balance sheet value if the company is not a listed company. And the minimum guaranteed value of a company which is listed has to be what? It has to be the market capitalization. Market capital. Can we calculate, work out market capitalization right now? Market capitalization. And they had given us market price per share somewhere. What is the market price they had given? Year-end market price is 24.55. 24.55 is the market price per share into the number of shares. So can somebody tell me the number of shares of the company? The company has 20 million. 20 million divided by 10. You get the number of shares and see the market capitalization. $2,000 divided by 24.55. That is 49,100. 49,100. And this 49,100 is what price? This is cum dividend price or ex dividend price? Cum dividend price or ex dividend price? Can somebody tell me, please? And if you go to page number 4, so the paragraph before the last one says the satisfactory performance increased STL's EPS to 5.18 in financial year 2024 from 3.93 in the previous year, an increase of over 32%. The board of directors has proposed a cash dividend to ordinary shareholders amounting to 3 rupees per share. If you pick the market price of a share from the market at a time the company having declared dividends, if you pick the market price of a share of the company at a time the company having declared dividends, having proposed dividends, obviously that market price per share should be the ex-dividend price or cum dividend price. That is cum dividend price. So therefore this value is little exaggerated and blown up. So this is cum dividend price, and let me take the ex-dividend price, 24.55 minus 3 rupee. That will be 21.55 into 20,000. 21.55 into 20,000. Sorry, 2,000. It is 43,100. 43,100. So this is the market capitalization ex-dividend. This is ex-dividend price. Ex-dividend price. So that can be sometimes a question in the paper. The examiner will be asking you to value the company using different methods. Okay? Balance sheet approach, market approach, and cash flow approach. Cash flow approach. So if you take the market approach, the easiest one is the market capitalization. It's very easy to do the valuation using the market information because the company is already listed company, and you need not to take the market details of peer or comparable companies why the company itself is listed, so they have their information for themselves. Okay. Then business acumen. Business acumen. What do you mean by the business acumen? How knowledgeable the management is of the business that they run, and how expertise are they in the particular area and the field. How eminent are they? How eminent are they in their respective field of operations now? Real company was developed and the CEO has been Dr. Hans Vijayasuriya, and his name has been disguised into Lionel, and Lionel is holding a PhD in this particular area. So therefore I don't think there is anyone better in this industry than Mr. Lionel, because he himself is an erudite and eminent guy, and he knows ins and outs of the industry. So he is a renowned character in the industry, a giant in the industry. He knows technically the business ins and outs, and he knows the operations ins and out, and then also the market leadership and the market dominance. Market dominance. Market dominance. Okay. Now, we have studied in our theory class, I don't know where you follow theory classes. When you value a company using the price earning, when you value a company using price earning, I mean, if the price earning is higher, that is because the market price is higher. So what will be instrumental for the market price to be higher? What can be conducive for the market price to be higher? You expect the market price to be higher for many reasons. What are these many reasons? Strong governance. Strong governance. And this company's governing structure seems to be little strong. I did not get into the details from the auditor's auditing perspective, but since the company is a listed company and they must comply with the governing requirements of Security and Exchange Commission Act, if not their listing will get cancelled, so their governing structure will be, yeah, correct. Governing structure will be very strong, and for the market price to be higher, the company has to be a fully stabilized company. Stabilized company. Now we have understood the fact that this company is a very stabilized company, and we will try to prove it using some calculations and statistics. Okay? And just by the company being a stabilized company, you cannot expect the market price to be high, because sometimes a company being a stabilized company will be in the short run, and we can't expect that to be in the long run. So the market price will go up permanently when the company will be a stabilized company in the long run. Okay, in the long run. So this company is a stabilized company in the long run. And also we expect the market price to be high when there are growth in the profits. Growth in profits. And also we expect the market price to be high when there will be stable profits. Stable profits. We'll look into the details with the statistics to understand how stable the profits are and how stable their earnings and the cash flows are. So the information was given in some pages of the pre-scene, and we'll look into those details. So at a glance, even without you scrutinizing Further, if you just have a small rough guess, if you do a small rough guess, these are the strengths of this company, and we'll try to understand them. Again, see, the company has a long history. The company is a listed company, and the company has a market capitalization of 43,100,000, I think 43 billion, it must be 43 billion. Okay, so that is ex-dividend price, business acumen, market dominance. Market dominance, number 3 is repeated. And a strong governance, stabilized company, growth in profits, and the profits are stable. So there are many more, but these are the main and the key strengths of the company. So this is what that would have collectively contributed the market price to go up, and the market price has kept growing over the years, and there's not been a downfall. So there's no recession for this company. It has kept growing, and you can understand how rapid the growth has been when you get into the details calculations. Well, now, are these clear? Are they clear? Okay. Right. Page number 4 has given you some information. Has given you some information in a tabulated form, starting from 2010 right up to 2024. Mobile subscriber base starting from 4.35 billion, so that has been growing up to 14.99 billion. 14.99 billion. Okay. 14.99 billion. Sorry, it is million, not billion. 14.99 million. So almost 15 million. Now you know, these are the number of people basically. And in the country by 2025 or by the end of 2024, there were only 22 million populations in the country. So this company would have been the service provider for almost every mobile use of the company, of the country. Now out of 22 million, we don't expect everyone to use a mobile. Small kids are not using the mobiles. And these adults, generations who will be more than say 90 years, maybe 80 years sometimes, they are not using the mobiles. So the people who use the mobiles will be the people like you. And that is, you can just figure out how big that population can be. I don't think that can be bigger than 15 million people. The people who use a mobile in the country cannot be greater than 15 million. And this company has been providing services to almost 15 million populations in the country. What does it mean? Every mobile user of the country has been a customer of this company. Has been a customer of this company. So that means what? There is no one who has not been a customer of Dialog or this company in the country. So that shows how rapid their growth has been. So that is from 4.35 million to 15 million altogether, starting from 2010 right up to 2024. I don't think there's any company, there's any other stronger company than this. I don't think there's any other company whose market share is greater than the market share of this particular company. So that is a strength. That is why I said this company is a fully stabilized company, growing company, and it has gone to the highest level. And if you put this company into the BCG metrics and they are at this star level, you can't expect this market to further grow. You can't expect this market to further expand. Why? Almost everyone who has the capacity to use a mobile is using a mobile, and this company has gone to almost every mobile user to provide their services, so the market will be stagnant to some extent. Right. And then revenue. Revenue starting from 20.88 billion, it has grown up to 120.05 billion. And you can work out the revenue per customer. Revenue per customer, I can do the calculations and you can do it for yourself. As far as I can remember, starting from 2010 right up to 2024. And it was 2,000 rupees per customer, revenue per customer was 2,000, and in 2024, revenue per customer was like 8,000 rupees. 8,000 rupees. What does it mean? If you use a mobile package and if it is dialogue, your normal average bill has been like 8,000. 8,000 average. There are some people whose bill can be 50,000 rupees a month. So there are some people whose bill can be like 100,000 rupees a month. And there are some small people whose bill can be just 1,000 rupees a month. If you level it off and average it off, the average income per customer has been 8,000. I did not do the calculation now, but I did calculations before. So the revenue per customer has been growing from 2,000 to 8,000. So that shows how stable this company is, that shows how stabilized this company is, that shows how rapid the growth of this company has been. Okay, ne? Right. I just give you a small calculation to do. Please, can you calculate the dividend growth rate? We'll calculate the dividend growth rate. Hurry up, quickly. We'll calculate the dividend growth rate. $8.76. We'll see. Others? Okay, we'll see. The very first year in which the dividends were paid was 2010. The dividend payment was 0.40 cents. The last year in which the dividends were paid was 2024. The dividend payment there was how much? 3 rupees. So we can apply this formula to work out the growth rate. Future value is equal to present value into 1 plus r to the power n. Future value is 3, present value is 0.4, r is not known, and how many years? How many years? Starting from 2010 to 2024, how many years are there? How many years? Hurry up. It has to be in fact 13 years, not 14 years. Why? In our calculation, 2010 has to be taken as year 0. So this is the dividend payment in year 0. And if you take it as year 0, from 2010 right up to 20, that's not a big issue at the exam. I don't think there will be a material difference even if you take it as 14 years. That's all right. Don't fight over small penny matters. But let me take it, to be precise, let me take it as 13 years. Then 3 divided by 0.4 to the root of 13 minus 1 is equal to r. That is 16.7. 16.7 growth rate. A massive growth rate. A massive growth rate of dividends. Can somebody tell me why this dividend growth rate would have been that high? Can somebody tell me why the dividend growth rate was that high? Any guess? Any guess? What do you think would have been the reasons for this dividend growth rate to be that high? Yes? Any guess, Udari? Profit growth is high. Okay. Any other reason? 𝐿-𝐻, a familiar name. Any other reason? EPS has been high. Too much. The investors' expectation. Good. Investors' expectations would have been too much. Even the others were correct. There were growing profit and growing EPS. And you know what this group structure is. I could not tell you what the group structure, but you know it for yourself. And Singapore Telecom Company has been the main investor in STL. And they have invested 80% into the share capital of this company. Balance 20 has been acquired by Mr. Lionel. And this STL company has another 2 more subsidiary companies. One is PPL, the other one is Vista TV. And these 2 companies were acquired by STL in 2017, if I am not mistaken. Since this foreign company is the main investor, maybe they wanted a higher return. And this investor has been from Singapore. And our dividends and their dividends will not be matching to each other. So for our dividends to be made match to the dividend expectations of the Singapore investor, so you need to pay a higher dividend to the investor in Singapore. And also, since the investor is not a local investor, they try to grab their entire return, they try to bring their entire return back to their country. So it's not like you getting a local party to invest into the company, They don't try to pull everything out from the company. Why? You are in the same country. But if you get a foreign investor to invest into the company, the expectations are different. So they want their total profit to be brought back to their country. So the profits being high was one reason, EPS being high has been another reason, and more importantly, predominantly, the expectations of the shareholders of this company would have been pretty high. Okay, right. Now, they have given us WACC for this company, not exactly the figure. They have given us the range of the WACC. The actual figure has to lie between these two extremes. What are these two extremes? They have given us a range. What is it? This WACC is lying between yes, it was 12 to 14. 12% to 14%. We can work it out. So that calculations will be necessary to do some other calculations. Okay. To work out WACC, you need cost of equity and cost of debt. Cost of equity can be calculated using two methods. Either it has to be CAPM, risk-free plus beta into market return minus risk-free return. And for you to work out cost of equity using CAPM, the pre-scene has not given us enough information. So that's not detailed enough for us to pick it up to work out required rate of return for equity shareholders using CAPM. Just leave it aside. If not, we can work out cost of equity using dividend growth model. D0 into 1 plus G divided by P0 plus G. So we have enough information to work out cost of equity using the dividend growth model. And then you can work out cost of debt. So nowhere does the pre-scene say what the cost of debt is, but still using some information in the pre-scene we can work it out. We can work it out. So let's try to work out the WACC calculations to see what exactly their WACC figure is. Okay, then right. Now already we have calculated the growth rates. That was 16.7. Dividends are 3. 1 plus G, that is 1.167. And they have given us the market price per share. That was 24.33, 24.55, and that is cum dividend price, and we'll take the ex-dividend price. Ex-dividend price was how much? 21.55. 21.55 plus 0.167. 0.167. 3 into 1.167. divided by 21.55 plus 0.167. So that is almost 33%. 33% dividend, 33% cost of equity. Cost of equity is 33%. Okay, very high cost of equity. The cost of equity would have been made so high, pretty high, because we had those reasons. The expectations of return of the investors would have been pretty high. We know what the reason was. Now, it's not like you getting a local investor investing into the company, and then whether he withdraws money from the company or not does not make a big difference. Why? We all are in the same country and the same territory. But if you get a foreign investor to invest into the capital, the expectations can be different. Always they try to pull all their profit out. So they want to pull their profit out. So they don't want their company to become they don't want their company to prosper, but they want themselves to prosper. So that is why, having no regard on the prosperity of the company, so they will try to pull out all their money just to prosper themselves. So that was one reason. Okay, 33%. And then we'll work out cost of debt. That's not given explicitly in the pre-scene, but you can work it out. And let me take, we'll go to profit and loss. Go to profit and loss, take the total finance cost. Total finance cost is how much? 4,656. We look at it from the company's perspective, don't look at the group. 4656. 4656. And we'll divide it by what? We'll divide it by debt capital. We'll divide it by debt capital. Let's look at the debt capital. Let's look at the debt capital. Take secured, unsecured debt under non-current liabilities. So that is in the company. Okay, ne? And then take lease liabilities as well. 21,500 plus 38,599 plus 6695 plus under current liabilities we have borrowing secured and unsecured 9569 plus 11,855 and lease liabilities 1,450. So altogether it is 89,669. 89,669 into 100%. 4656 divided by this into 100, you get 5.2%. 5.2% cost of debt. Please ensure my calculations are correct. Okay, now cost of debt is 5.2. 5.2. 5.2. Thank you, Dari. So this 5.2 is a pre-tax cost of debt or post-tax cost of debt? Pre-tax or post-tax? It is pre-tax. What is the tax rate? What is the tax rate? Have they given us the tax rate? 30%. Okay. Then we'll calculate post-tax. Post-tax 5.2 into 70%. 5.2 into 70%, so that was 3.64. 3.64. Now we can work out WACC. We'll complete WACC. Okay, ne? Right. And we can take the capital structure. You can take the market value of equity, but just leave the market value of equity. That is the most appropriate method, but sometimes it can be a little misleading. Let me resort to book value of equity and book value of debt. What is equity capital in the company? 41,569. That is equity capital. What is debt capital? Debt capital is 89,669. So we'll take the total. Into 100. Into 100. 41,569 divided by 131, 238. Equity has to be 32%. and debt has to be 68%. Now we'll take WACC calculation. %32 into 33 plus 68% into 3.64. $10.56 plus 2.46 plus 10.56, it is 13%. It is 13%. Yes. So our calculation looks right because they have said that in the pre-scene the WACC has been within the range of 12 to 14. So it cannot go, it cannot fall outside these two extremes. Cannot fall outside these two extremes. It has to be either 12 or 14, or it has to be in between. Okay. Are they clear? Thank you, Dari. Others? Right. Now they are capital structure. Debt capital is 68%. Equity capital was 32%. The company is a geared company. Can you justify the reasons why this company is a geared company? Can you tell me the reasons why the company has more debt than the equity capital? Yes. Yes. Yeah. Normally, the benchmark is what? To calculate capital structure, we take not the book values, we take the market values. Where the market values are given, that is what you have to take. But where the market values are not given, you have no option but to take the book values. Where the market values are given, please resort to market values, not the book values. But this company does not have any marketable debt securities, debt instruments. While they have taken borrowings and leases, none of them have the market values. So we can take the market value only for equity. So just to avoid this incompatibility only, I have taken the book values. There's nothing wrong in you taking the market value. Right. Can somebody say the reasons why this company is a geared company? Is it because this company really wanted debt capital? What do you think would have been the reasons for them to go into debt? What do you think would have been the reasons for this company to resort and rely more on debt capital, not on equity capital? Yes. Sudari. Equity capital is more. Yes, that is one reason, Taridu. Equity capital is more costly than debt. We understood the fact that in our calculations, equity capital, their cost is 33%. And if you have more equity capital in the company and less debt capital, just imagine how big their cost of capital would have been, weighted average cost of capital. The bigger the weighted average cost of capital, the lesser the market value of the company. And the bigger the WACC, the higher the WACC, the lesser the chances of you being able to accept new projects. Why? All the new projects need to be discounted using this higher WACC. So hardly can we expect accept a new project. Why? Because you will get negative NPVs. Why? You will start discounting it using higher WACC cost of capital. Yes. So therefore, just to dilute this WACC figure, just to bring it to a moderate and a mediocre level, you need to infuse more and more debt capital. And for good or for bad, this company's debt capital is less expensive, very cheap, and that is only 5.6 pre-tax. So the best decision is to use as much debt capital as possible, whereby we can bring this average capital to a moderate and a mediocre level. If not, that would have been a big issue for the company. Why? This is a more technology-driven company. This is a more technology-driven company, and then they have to take higher cost of capital. So that is one reason. The other reason why cost of equity is high, very important. Now we calculated cost of equity using dividend growth model. The examiner has given us the range of WACC, that is 12 to 14%. And which method is superior of these two? Dividend growth model is superior to CAPM model, or CAPM model is superior to dividend growth model. What are we used the most? What are we using the most? What is used the most? Now, out of these two methods, which one did we use the most in our calculations in our theory class and in the past paper discussions? We used CAPM model. CAPM is superior. To calculate cost of equity using CAPM, you need risk-free, beta, market return, and risk-free. And all these are market information. Risk-free rate has to be a common rate for all the companies, and that has to be a market information. Even market return has to be a common information for all the companies in the capital market, the companies that are listed in the share market. So what is the unique information for the company? What is the specific information of the company? Only the beta factor should be specific, yes. Now the beta has to be a higher figure for this company. Can somebody tell me the reason? The beta has to be a higher figure for this company. It has to be a higher coefficient for this company. Can somebody tell me the reason? Highly geared nature, okay. Gearing is high, so financial risk is high, so beta has to be high. That is one reason. Another reason? Another reason, another reason, another reason, and their business is right. Industry is high, operational risks also high since technology driven. So this is a technology driven company. So they are more into technology, and this technology keeps changing. So they need to keep pace to the changing technologies. The technology we are using today will not be the technologies to be used in 1 year's time. So unless this company keeps pace with the changing technology, so the environment is more dynamic. So they need to keep pace with the dynamism. And if they can't keep pace with this changing dynamism, the company will get thrown out of the market. So their business is very risky business. Why? It is a technology driven business. If the business is risky, obviously beta has to be high. The other one, this company is a diversified business or not a diversified business? It's a diversified business, is not a diversified business. Ever since the company was set up, not diversified to that good. It's not a diversified business. So ever since the company was set up right up to the current year of 2025, they are into just 1 or 2 business activities. So the sole breadwinner of this company is providing the same services. So that is what they were fully focusing on. So that is what they were the best at. So it was, very risky business while less diversified, and this is a technology driven company, and expectations of the investors are very high. So that is why the beta has to be high. As the beta is high, obviously cost of equity has to be high. Therefore, if you stick to only equity capital, their WACC has to be high, and then their projects, they cannot accept any projects whereby all the projects that are likely of being profitable in the future, all the profitable projects that would have been otherwise profitable will become loss-making ventures for this company. Why? Their cost of capital is high, so they want to bring it down somehow or other. For them to make it a lower cost of capital, they need to use as much debt capital as possible. So that is the main reasons why this company would have been more into debt, not because the company wanted outside money. And Singapore investor is a very wealthy investor, so they can infuse as much debt, equity capital as they wanted, but without going for more equity capital, they would have resorted to more debt capital to get these benefits out of debt, especially tax shield, and comparatively, the cost of debt in this company is multiple times cheaper than cost of equity. Are they clear? Are they clear? Okay. Now, can we calculate asset turnover, NP margin, and DuPont gearing? Asset turnover, right, asset turnover, take revenue. Revenue is divided by total assets. NP margin, net profit after tax, divided by revenue. Into 100. DuPont gearing total assets divided by equity. Revenue, we'll take revenue from the profit and loss. Company 80,402,000 divided by total assets 155,785. It is in number of times. NP margin, total revenue 80,402, and net profit is how much? Profit after tax 6,154. DuPont gearing total assets 155,785 divided by equity capital. How much is equity capital? 41,569. $80,402 divided by 155,785. That is 0.516. 6154 divided by 80,402 into 100, it is 7.65. DuPont gearing 155,785 divided by 41,569, 3.7476. Now let me take ROE, return on equity. Profit after tax divided by equity into 100. Profit after tax is 6,154 divided by equity 41,569 into 100. $14.8. Now we know the determinants of ROE. Determinants of ROE has to be efficiency, that is asset turnover, profitability margin, that is net profit margin, and gearing, that is DuPont gearing. So let me multiply these three together. 0.516 into 7.65% into 3.7476. You get 14.8. It tallies with this ROE. Right. So what is it for? We'll do a small comparison. We'll do a small comparison now. Now we calculated cost of equity was calculated, WACC was calculated. Say cost of capital overall, equity shareholders. What is overall cost of capital? That was WACC, that was 13%. Cost of capital specific equity, that was 33%. If I am not mistaken, as far as I could remember, it was 33%. Cost of equity, sorry, we'll take now the comparable figures. What do you mean by WACC? So you need to pay what do you mean by WACC? That is 13% on average to all the capital providers of the company for every 100 rupee worth of capital, irrespective of whether they are equity or debt capital. For every capital provider of the company, company has to pay 13 rupees. 13 rupees to be paid to every 100 rupee capital provided of the company. So that is the cash outflow from the company. And for you to pay that return, committed return to the capital providers, where do we take money from? Nowhere else but from the business. But from the business. So how do you ensure that we made enough profit to pay this return to the capital providers? So you need to look at another ratio that has to be ROCE. ROCE. ROCE has been given in the pre-sheet. How much is ROCE? How much is ROCE? ROCE is given in this page number 4, point number 7. Return on capital employed is 9.8. 9.8. Okay, ne? 9.8 has been ROCE. Out of every 100 rupee capital, irrespective of whether the capital is equity or debt capital, out of every 100 rupee capital, the company has made only 9.8 rupee profit, but for every 100 rupee worth of capital, the company has a commitment to pay how much? 13. 13. And the cost of equity is 33. What is return on equity? Return on equity is 14.8. Now see, there is a big issue. You make only 9.8 return from every 100 rupee worth of capital to pay out a return to the capital providers of 13%. You heard me right. You generate only 9.8 rupees out of every 100 rupee worth of capital. You make only 9.8 rupee profit to pay out 13 rupee return for every 100 rupee worth of capital provided. And this problem is aggravating when it comes to equity capital. So you have to pay 33% for every 100 rupee equity capital, but you get every 100 rupee equity capital to make you only 14.8 rupee worth of a profit. So there's a big disparity. Big disparity. So this company will have a big issue in the future if these two will not be controlled. Will not be controlled. Are they clear? Thank you, Dari. Others? Others? There are so many others. 𝐿𝐼, 𝐷, 𝐶, Sanjay Bandar. I hope he was not the previous president. What I said was, now cost of capital was 13%, that is WACC. ROC is 9.8. What does it mean? To equity and debt capital providers, you have a firm and a promise commitment of 13%. For every 100 rupee worth of capital, irrespective of whether they are equity or debt capital, for every 100 rupee worth of capital, you have a commitment to pay 13%. Your commitment to pay to the capital providers, whether they are from equity category or debt capital, for every 100 rupee worth of capital, you have a commitment to pay 13%. That is your cash outflow. And for you to pay that 13%, where do we get money from? You get that money from your operation. From every 100 rupee worth of capital of the business, what profit have you made? It was only 9.8 rupee. from every 100 rupee worth of capital, irrespective of whether they are equity capital or debt capital, from every 100 rupee worth of capital you made only 9.8 rupee profit. So this is your cash inflow and this is your cash outflow. So you need to pay out 13.8 to the capital providers only out of 9.8 rupee worth of a return. So these inflows and the outflows are not matching to each other. So the outflows are big and the inflows are low. So this company will have a big problem in the future if they do not control these two, and there's a very big disparity. Outflows are big and the inflows are lower. So if the company does not control them, there will be a big issue in the company going forward. And so should be cost of equity. Cost of equity is 33% and ROE has been how much? 14.8. So the company has promised to pay 33% return to the equity capital providers, but every 100 rupee worth of equity capital generates only how much of a profit? That is only 14.8 rupee worth of a profit. So you generate lower profit, but you promise to pay out a bigger return. So there's a big disparity. Is that okay? Right. And this pre-scene talks about how these two subsidiaries were acquired. That was PPL and Vista TV, and how they were valued. So that is dead and gold. So that was long before. So the acquisitions have taken place in which year? 2017. So that area is very unlikely of being tested by, so no point of talking about the companies which were already acquired. So the company, the examiner in the question paper need to set questions not about the companies which were already acquired. He has to set questions about the companies to be acquired in the future. So you need not to have any regard on these acquired companies unless we are going to sell them. Unless they are going to sell. So I don't think the company will sell any of these companies. Why? They must have within the group. They must have within the group for them to survive in the future, for you to get this entire business moving forward in the future. You must keep those two companies within the group. So I don't think there will be any questions relating to divestments, I don't think, but it will be altogether what? Further investments. Why do they need further investments? One thing, so no point of making further investments in the industry. The parent company still has gone to the highest possible, is culminating now. Unless they push their boundaries of the industry, they can't do it. For them to do it, they must import people from other countries. So they must make people born newly. So they can't do it. So they have given the services to almost every mobile user in the country, and they cannot expand their existing business any longer. So they are planning to invest and they are planning to move into new business, and that is basically education industry, and sometimes it can be a local company, it can be a foreign company. It can be a local company and a foreign company. So they are planning to make investments either in one of the local companies. They have shortlisted one company, that was BCC if I am not mistaken, and also they are planning to acquire another business in Maldives. And the pre-scene keeps explaining how this funding strategy is done. funding strategize how. Now, in the group, parent is STL, and there are two other companies, they are subsidiaries. One is PPL, the other one is Vista TV. Vista TV. What they say is, now STL being the parent company will originate money, and that will be given to these two companies. I think it was given in the paper pre-seen. Financing strategies, page number 10, point number 30. STL's policy is to borrow centrally using a mixture of long-term and short-term capital market sources and borrowing facilities to meet anticipated funding requirements. These borrowings and cash generated from operations are loaned internally or contributed as equity to certain subsidiaries. In addition to its regular bank borrowings, STL has recently entered into an agreement with the International Finance Corporation's IFC and has access to a loan facility of up to 100 million. Okay. So therefore the investments will be done basically not from STL, investments will be done basically from PPL and Vista. And how do they get capital? For them to make investments in other new projects, it is STL who will raise capital first, and then that capital will be given to these subsidiary companies. Subsidiary companies. So sometimes it can be starting up a new project, or sometimes it can be starting or acquiring an existing business. Acquiring business. So whether it is starting up a new project or acquiring new businesses, existing companies, locally or internationally, you need to do calculations. Why? If it is a new project, you need to appraise the project using cash flows. If it is an acquisition of an existing company, you need to value the company before you acquire. So without knowing the value of the company, you can't just dump your money just for the sake of doing. So therefore, you need to take cash flows and you need to use discounting rate. It has to be cost of capital. Here cash flows need to be discounted using cost of capital. So what discounting rates are we using? If you starting up a project, the cash flows need to be discounted using cost of capital of the investor. So the investor at the front line will be one of these two companies. So there will be another investor behind the scene, behind the screen. What is STL? So the new project has to generate enough funds to pay return to the first investor and to the second investor. So you need to decide the discounting rate in a way that you generate enough money to pay the return to the investors. So if you discount a project, the cash flows need to be discounted using the WACC of the investor. WACC of the investor. And if you value a company, the cash flows of the company should be discounted using the WACC of the investee acquiring company. So that's what we did over many years. I mean, when you discussed the past paper, if you were in our theory classes before, so that's what we were doing. That's what we were doing. Okay, so I hope you got the difference. If you appraise a project, you must take the discounting rate. Whose discounting rate? Investors' discounting rate. And if you acquire a new company, you need to value the company first, and for that valuation purpose, you need to discount cash flows of the company, and whose WACC are we using for discounting purpose? It has to be nothing but investees WACC itself. Investees WACC itself. Are they clear? Okay, ne? Right. Then, now it's clearly indicated that the financing strategies, STL has already entered into a contract with someone to take 100 million USD. So I'm pretty sure when you do these WACC calculations, whatever the purpose, it can be for the purpose of starting up a new project, or it can be for the purpose of acquiring a new company. Please ensure if they take 100 million foreign loan, USD loan, you need to calculate WACC also by including the cost of equity of foreign loan, cost of capital of foreign loan. And we have discussed how to work out cost of capital of foreign loan. It has to be IRR calculation also by including the losses arising out of local rupee depreciation. Please be ready for that. Okay, ne? So there will be questions on acquiring new companies. It has to be a foreign company sometimes. It can be a local company. Okay, I'm pretty sure it can be a local foreign company sometimes, basically foreign company, and need to be ready for that. And you need to know how the foreign companies are valued and foreign projects appraised. Be ready for that. Okay. And in risk management, this company has a lot of foreign currency transactions. The biggest foreign currency transaction can be what? They must be paying dividends to their foreign investor Singapore company. So dividend payment in dollars. So they need to deal with banks and the currency brokers. So whenever they purchase dollars out of rupees, so there will be lot of exchange risks, there will be lot of exchange losses. And their capital structure is debt dominated capital structure. Interest rates were 5.3. For the moment, interest rates are very favorable, very low. But if they have taken loans at variable rates, when the rates will increase in the future, you will get into problems. You will have to pay high rates. So therefore, whether you like or not, this time there will be questions on risk management. Why? It can be exchange rate risks, or it can be sometimes interest rate risks. You need to be ready for that. Why this company is heavily geared on one hand, and this company will be more into foreign currency transactions. Foreign currency transaction. So that is all about the pre-scene. I mean, that is more than enough for you to get ready for the exam. So those are the areas. Now, I don't think you will get working capital management questions unless the question will not be connected to the pre-scene. Why? They don't have any working capital issues. They have only one problem of not being able to collect their money from the customers. Why? There is a huge amount of debtors. So they can ask some questions on working capital management regarding debt management. They don't need to keep inventory. Inventory will be a small, insignificant figure in the balance sheet. So you need not to be ready. That's what I felt personally. Working capital management, you need not to think of over trading, over capitalizing and things like that. Portfolio management, that depends. That depends, because if they want to make investments elsewhere, they are cash rich company, isn't it? Yes, cash 20. They can make investments either by acquiring existing companies or go for going for new projects, or they can go to make investments in the capital market. They can go to investments in capital market. So that is portfolio management. Can be a possible area. Be ready. Okay, especially the company is a listed company. So I don't think there will be working capital management. There can be performance evaluations, and we did it now. How we compare cost of capital and the return. Return has to be ROCE and cost of weighted average cost of capital, or it has to be cost of equity and ROE, performance management. Okay, so it has to be basically valuation. It can be sometimes portfolio management. There can be questions for risk management, and mergers and acquisition. Cost of capital, basically cost of capital. So those are the prominent areas where we can expect questions this time in the paper. If you want me to explain anything else, please let me know. And if not, we can finish our discussions on the pre-scene, and we can go to this. We can start discussing the last paper. Anything else? We are starting to discuss the last time paper now. We'll take a small break and then we'll start discussing the last time paper. Others? Okay. So let's take a small break and then start discussing 2024 December paper. Right. Are you all there? Okay. Question number 1, part A. Omega Private Limited is a construction company based in Sri Lanka. The company is currently assessing an investment project for its subsidiary in India, a politically stable country. The project requires an initial investment of 10 million Indian rupees and is anticipated to generate the following nominal cash flows. Cash inflow 2.5 million Indian rupees, 3 million, 3.5 million, 4 million, 3 million. The following information is also available. The expected inflation rate is 4% per year in India and 8% per year in Sri Lanka. Current spot exchange rate 1 LKR is 0.25. In other words, 1 Indian rupee will be 4 rupees in Sri Lanka. The corporate tax in India is 30% and in Sri Lanka it is 40%. Tax is payable in the same year that profits are earned. The two countries have entered into a double taxation agreement, thus double taxation relief is available. Tax allowable depreciations of INR 2 million per year straight line is available. Omega charges its overseas subsidiary 100,000 Indian rupees per year for the provisions of internal services. An additional LKR 300,000 in nominal terms per year of administrative costs will be incurred by Omega to support the new investment. Omega's nominal cost of capital is 14%. Required to calculate the net present value of the project in LKR and advise Omega on the acceptability of the investment. Right. Can you all hear me? Right. Okay. Thank you. So just a small foreign investment appraisal. No complication at all. So we'll do it. take the years, year 0, first year, second year, third year, fourth year and the fifth year. Initial investment is 10 million. Initial investment is 10 million cash outflow. We'll take the cash inflows. Cash inflows. First year 2.5. Second year 3 million. Third year 3.5 million. Fourth year 4 million. Fifth year 3 million. 3 million. Right. Now you can have different methods of presenting it. Now you need to work out the taxation. And you can have a separate taxable profit calculation elsewhere, or else without having any regard on your capital allowances, you can work out the tax payment on these profit figures. Okay, let me do that. That is easy. I will not deduct any capital allowances from these cash flows to work out the taxable profit, because that will take little time at the exam. So you want to save your time as much as we can. Okay, right? So you need to be mindful about the timing at the exam. Just for the sake of saving time, let me not deduct any capital allowances from these cash flows, and let me work out taxation on this cash flow straight. So what taxations are we to pay? What taxations are we to pay? Or else you can have elsewhere say taxation. Taxation, you need not to have a working either. Simply 2.5 million is deducted by what? Allowable depreciation, 2 million. So what is your taxable profit then? 500 into what is your tax rate? In India, tax rate has been 30%. So we will work out 30% on this. It is 150,000. And if you have time later, you can show the taxable profit calculations in a separate working elsewhere. We'll just not show that working for the time being, just for the sake of saving time. Second year, 3 million your net cash flow, and tax depreciation should be 2 million into 30%. You need to pay 300,000 worth of a tax. Third year 1.5 into 30%, 450,000. 450. Did I make a mistake? Wait. Omega is charging its overseas subsidiary Indian rupees 100,000 in nominal terms per year for the provision of internal services. Okay. Now Sri Lankan company is charging another 100,000 Indian rupees. 100,000 Indian rupees. So this net cash flow given 2.5 million for the first year, what do you think? It is after deducting 100,000 or before deducting 100,000? What do you feel? What do you feel? I think it's before. Examiner does not say anything about it. Please, we'll do a small change here. I feel the cash flows given by the examiner, net cash flow given by the examiner, are before deducting 100,000. Has the examiner said that specifically anywhere? It has not been given. It has not been given. So I need to reasonably presume that the given cash flows are before deducting 100,000 charged by the Sri Lankan operation from the Indian operation. We'll deduct it. Say, what is it for? 100,000 in nominal terms per year, internal services. Internal services. Let me deduct 100,000. 100,000 all along. 100,000. 100,000. Here also 100,000. Then we'll take taxation. Taxation. It is 2.5 million minus 100 minus 2 million tax depreciation into 30%, 120,000. Second year, 3 million minus 100 minus 2 million into 30%, 270. 270. 3.5 minus 100 minus 2 million into 30%, 420. 4 million minus 100 minus 2 million into 30%, 570. 3 million minus 100 minus 2 million into 30%, this is 270. 270. 270. Okay, ne? Right. Then we'll take net cash flow from the Indian operation. This is 10 million. $2.5 minus 220, 2,280,000. 2,630,000. This is 2,920,000. This is 3,330,000. $2,630,000. Then you need to convert these cash flows into Sri Lankan rupees. We'll convert them into Sri Lankan rupees. For that conversion, what do we need? You need to have the exchange rates. Exchange rates are needed. So the exchange rates for the next 5 years are not given. Instead, we can work it out using interest rate parity. Third year, wrong. 2990. 298. 298, yes. Okay. So elsewhere, let's calculate the expected forward rates. Expected forward rates. Spot rate is given 0.25. So what is 0.25? This is number of Indian rupees. Indian rupees. What is the denominator? 1. 1 is what? Number of Sri Lankan rupees. Sri Lankan rupees. So denominator is number of Sri Lankan rupees. Numerator has been Indian rupees. Accordingly, you need to know what inflation rate to be taken as numerator, what inflation rate to be taken as denominator. Right. Indian inflation rate is 4%. 0.25 is multiplied by 1.04 divided by Sri Lankan inflation rate, which is 8%, 1.08. We'll work it out. 1.04 divided by 1.08 into 0.25. So this is 0.24. This is the rate expected in 1 year's time. We need to repeat our process. 0.24 into 1.04 divided by 1.08. 1.04 divided by 1.08 into 0.24. 0.23. 0.23. So this is the first year interest rate, exchange rate, and this is the second year exchange rate. 0.23 into 1.04 divided by 1.08. 1.04 divided by 1.08 into 0.23. 0.22. So that is the exchange rate for the third year. 1.04 into 1.08 into 0.22. 1.04 divided by 1.08 into 0.22. This is 0.21. Fourth year. 0.21 into 1.04 divided by 1.08. 0.20. 0.20. So these are the exchange rates, and we'll apply those expected future exchange rates to convert these Indian rupee cash flows to Sri Lankan rupee cash flows. Year 0 spot rate now is 0.25. This is 0.24 in 1 year's time. I made a mistake. You need to divide, okay? Ne? Need to divide, not to multiply. Need to divide. 0.23, if you want me to explain the reasons, we'll explain. This is 0.22, 0.21, and this is 0.20, 0.02, 0.02. 10 million divided by 0.25, it has to be 40 million in Sri Lankan rupees. 2280 divided by 0.24. 9,500,000 in Sri Lankan rupees, the first year cash flow. 2,630,000 divided by 0.23. 11,434,783. 2,980,000 divided by 0.22. 13,545,455. 3,330,000 by 0.21. This is 15,857,143. 2,630,000 divided by 0.2. This is 13,150,000. 13,150,000. Okay, right. Now you need to take additional expenses incurred in Sri Lanka, that is in Sri Lankan rupees. Sri Lankan rupees. And also you must take that the Sri Lankan operations will generate a return and income. The Sri Lankan operations will generate an income and a return by providing services to Indian operation. So that has to be another cash inflow for Sri Lankan company. It was deducted from Indian operation, and you must include that into Sri Lankan operation. Now, the income that the Sri Lankan operation generates should be taxed at what percentage? 40%, no doubt about it. When you pay tax on that income that the Sri Lankan operation generates within Sri Lanka, you can deduct the expenses incurred in Sri Lanka. So now I will not do that because it's easy at the exam if you take all your incomes and expenses post-tax basis. You can take income earned in Sri Lanka minus expenses incurred in Sri Lanka. So that is the net profit that you earn within Sri Lanka. So that is what you need to pay 40% taxes on. So that's a different, it's another extra work. Calculating your taxes to be paid in Sri Lanka should be an extra work. So that is little tedious and that takes a lot of time at the exam. So might as well to take your incomes and expenses on what basis? Post-tax basis. Post-tax basis. Okay, fine. And then additional tax to be paid in Sri Lanka. In Sri Lanka, what is it? Now, Indian income, Indian profit will be taxed in India only at 30%. But you need to pay tax of 14% in Sri Lanka. So as a result of their tax treaty, dual tax agreement between the two countries, you need to pay taxes in Sri Lanka not in 40%. And if you pay 30% in India and 40% in Sri Lanka, altogether 70%, you work not for yourself, you work for the government of two countries and you can't survive. The total tax payment should be 40%. Out of 40%, you have already paid 30% in India and you need to pay the balance 10% in Sri Lanka. That's it. So let me work that out. Okay. First year, your taxable profit was 2005 minus 100 minus 2000, that was 400. 30% was already paid, another 10 has to be paid. That 10 has to be another 40, and this is to be converted into Sri Lankan rupees by dividing it by 0.24. 40 divided by 0.24 should be 166,667. Second year, what was your taxable profit? 2.5 minus 100 minus 2 million. I made a mistake. 3 million minus 100 minus 2 million. It was 900. Another 10% should be paid in Sri Lanka. It is 90. We'll divide it by 0.23. 90 by 0.23, another 391,000. 304 tax has to be paid in Sri Lanka. Third year, 3.5 minus 100 minus 2 million. Your taxable profit for the third year was 1,400,000. Another 10% should be paid in Sri Lanka, 140. We'll divide it by 0.22. 140 divided by 0.22, it's another tax of 636,364. Fourth year taxable profit was 4 million minus 100 minus 2 million into 10%, 190. Divided by 0.21. 904,762. Fifth year, 3 million minus 2,100. Your taxable profit for the last year was 900 into 10%, another 90 tax has to be paid, divided by 0.2. That is 450,000. 450,000. Let me bring those taxes. First year, additional taxes to be paid 166,667. Second year, 391,304. Third year, 636,364. Fourth year, 904. 702. Fifth year, 450,000. We'll take additional expenses to be incurred in Sri Lanka. We'll take them post-tax. What is the additional expenses to be incurred in Sri Lanka? 300,000. 300 into 60%, 180,000. It has to be 180,000 all along. 180,000 all along. Sri Lankan operation made some additional income by providing services to Indian operation. So that was equal to how much? 100,000 Indian rupees, and that becomes an income to Sri Lankan operation. So you need to convert that into Sri Lankan rupees and then again post-tax. 100,000 divided by 0.24 into 60%. It is 250,000. 250,000 say service income. Service income. 100,000 divided by 0.23 into 60%. 260,869,870. Third year, 100,000 divided by 0.22 into 60%. 272,727. Fourth year, 100,000 divided by 0.21 into 60%. That should be 285,714. Fifth year, 100,000 divided by 0.2 into 60% should be 300,000. So this is your final cash flow. Year 0, 40 million cash outflow. First year, 9,500,000 minus 180,000 plus 250,000 minus 166,667. 9,403,333. 11,434,783 minus 180,000 plus 268,770 minus 391,304. 11,124,349. 349. Third year, 13,545,455 minus 180,000 plus 272,727 minus 63,6364. 13,001,880. 15,857 143 minus 180,000 plus 285,714 minus 904,702 15,058,155 13,150,000 minus 180,000 plus 300,000 minus 450 12,820,000. Okay, right. We'll discount. Discount rate is given. Omega's nominal cost of capital should be 14. Obviously, the discount rate should be nominal rate. Why? All the cash flows were inflated by the respective inflation rates. How do we know that? Because even the exchange rate was taken using inflation rates. All the cash flows are inflated. So the cost of capital should be nominal cost of capital. You need not to work it out. It's given already 1.14. 1.14 squared. 1.14 to the power 3. 1.14 to the power 4. 1.14 to the power 5. 9,403,333 by 1.14. 8,248,538. 11,124,349 by 1.14 squared. 8,559,825. 13,001,818 divided by 1.14 to the power 3. 8,775,857. 15,058,155 by 1.14 to the power 4. 8,915,637. 12,820 divided by 1.14 to the power 5. 6,658,306. 8,248,538. 8,559,825. 8,775,857. 8,915,637. 6,658,306 minus 40 million NPV has to be 1,158,163. 1,158,163. Just make sure my calculations are correct, please. Are we okay? Are you all there? Right, thank you. So you need to advise Omega PLC that they should accept the project. Why? There is a positive NPV takedown. The project is acceptable. Project is acceptable as it gives a positive NPV of 1,158,163. Right. We are now moving on to part B. Question number 1, part B. Lanka Foods Private Limited, a prominent player in the Sri Lankan and Middle Eastern markets, specializes in producing and distributing high quality authentic spices and culinary products. LFL borrowed $150,000 to import 10 state-of-the-art machines from a renowned machinery giant in the United States of America on 1st October 2024 to enhance its operational efficiency and meet rising demand. These advanced machines are designed to streamline production processes, boost output, and maintain the high standard of quality that LFL is known for. The above amount needs to be settled in 3 months. The Chief Financial Officer of LFL is looking for hedging options to make this payment in 3 months due to the high volatility of the exchange rate market. The following annual interest rates and exchange rates are currently available. USD deposit rate, borrowing rate, LKR deposit rate and borrowing rates are given for 1 month and 3 months time. Spot exchange rate, $1 is equal to 301.52 and 305.71. 1 month forward trade is given, 3 months forward trade is given. Required, determine the best possible hedging method available to LFL. So very simple question. Apparently the company seems to rely on only 2 hedging strategies. What are these 2? Forward trade plus money market hedge. So the forward trade is very explicit. I mean, that's given in the question explicitly, but money market hedge is not explicit, but the way the question is worded, the way the information was presented in the question, indirectly the examiner requires us to work only forward rate and money market hedge. So forward is very simple and basic. Today, is where you purchase the machine and its value is $150,000. And this is supposed to be settled or we have borrowed $150,000 to settle the value of the machine. Okay. So we are purchasing a machine for a value of $150,000 and we have purchased it using borrowings of $150,000, and this borrowing need to be settled in how many months' time? Borrowing has to be settled in 3 months' time. Today, and this is in 3 months' time in the future. 3 months' time in future. So this is where you are supposed to settle $150,000. $150,000. We'll first use forward rates. Forward rates. $150,000. The examiner has given different rates. Lead payment is not possible because to do the lead payment, the examiner has to say that we have taken the permission from the other party. So without you receiving the permission from the other party, we can't make the lead payment. Why? Just because you pay, the supplier may not be willing to accept the payment in advance. So you can't make the lead payment without you getting the supplier accept. And this is now not the payment to the supplier, we have borrowed money. So we need to settle it to the lender. That's what the question says, borrowing. So in borrowings, lead payments are not possible at all. And the lead payment, you would have considered lead payment as a workable solution if you were to make the payment direct to the supplier, not to the bank. You can't even negotiate with the bank to make the payment, lead payment. Why? The bank does not accept the lead payment. You must make the payment as the payment becomes due. Okay. Then, forward rate. So we must take 1 month forward trade or 3 months forward trade. It has to be 3 months. It's quite obvious. And this quotation is direct quotations or an indirect quotation. Direct or indirect quotation. Direct or indirect? It is direct quotation. So you need to buy dollars and the bank is selling dollars. You need to look at, need to understand the selling and the buying rates always from the bank's point of view, from the bank's perspective. So then the selling rate has to be the higher rate and the buying rate should be the lower rate. You must take the higher selling rate. 3 months forward, 310.68. $150,000 into 310.68. So that will be 46,602,000 Sri Lankan rupees under forward rate. Then we'll take money market hedge. So you need to pay $150,000 in 3 months' time. So we need to pay it not to the bank, we will pay it to an investment account. So that's like you keeping this money invested in a temporary investment account of 3 months' time. So how much are we to invest? It's not necessarily $150,000. Why? If you invest dollars in a temporary investment account, your $150,000 collection in 3 months' time should be with the capital plus interest to be accrued over 3 months time at whatever the rate. So what is the rate? You must take deposit rate for 3 months in dollars. Deposit rate for 3 months in dollars 3.75. Deposit rate for 3 months in dollars 3.75 divided by 12 into 3 divided by 100 plus 1. So this is divided by discounted by 1.009375. So the present value should be 148,607. Now forget about all these nonsense of money market hedge and just assume that we are going to make the payment straight to the bank today. We are going to make the payment straight to the bank. Why do we take 3 months forward rate? Now you can't take 3 months forward rate. You must Paradi. Okay. 88. What is the value? 150 into 310.88. 46,632,632. Right. Now this 148,607 should be multiplied by spot rate. Spot rate selling rate. What is the spot rate selling rate? 307.68. 307.68. 148,607 into 307.68. 45,723,402. So this amount of money has to be borrowed because we are not using our own money. Why aren't we using our own money? Because we are optimizing the tools in the money market. So the hedging will be completely based on what? Money market. We are optimizing the use of equipment in the money market. So we are not using our own money. Even though the examiner says that we have enough money to take these dollars with spot rate okay. Spot rate is 305.71. Yes, made a mistake. 305.71. Rupee value 148,607 into 305.71. It is 45,430,646 into interest rates. We will take LKR borrowing rate for 3 months. LKR borrowing rate for 3 months, it is 11.75 divided by 12 into 3 divided by 100 plus 1. 1.029375 into 45,430,646. You need 46,765,171. Please check the calculations up. Check the calculations. Check the calculation. Only figures on ippathara page. What happened on ippathara? Okay, thank you. Yes. Okay. So which one is better? Money market hedge or forward trade? Forward trade seems to be better. We are recommending for the company to go for money market, for forward trade, not for money market hedging. Okay, right. So by and large, the entire question number 1 was a small question, easy question, so that you can score 25 out of 25 if you do not mess up your calculations. I mean, principally, concepts, there is no complications in applying the concepts. You can straight away apply the concepts, only just that you need to do the calculations without messing it up. Is everyone okay? A lot of students are there, but no one is responding except Chula and Udari. Are you all okay? Right. Please make sure that you will not lose the focus and you will not be distracted. The concentrations and the composure will be important at least before the exam in the morning. Just meditate at least for 10 minutes and go for the exam. Moving on to question number 2. Question number 2, part A. A group of shareholders of company A PLC summoned a meeting with the board of directors of the company as well as key managerial personnel who oversee the company's operations to discuss a few key challenges encountered by them recently. At the meeting, the shareholders highlighted the following points. Acceptance of few projects recently which were too risky, even though it has been clearly mentioned to the management of company to manage risks within the stipulated limits. This resulted in a loss of rupees 2.3 billion. Increasing the salaries of the top management by 50% despite the company having recorded a net loss for the last 2 consecutive quarters. However, this has been justified by the management as an inflationary adjustment. Implementation of working from home for 60% of the staff has caused some of the key projects to get significantly delayed due to a risk of focus, due to lack of focus. A few shareholders pointed out the need for a change in the board of directors together with key managerial personnel with immediate effect. However, it was seen as a risky decision due to too much dependence on them. Alternatively, Fernando, one of the shareholders of A, expressed his viewpoint as follows. This is not a situation unique just for APLC. There are many other ways to manage these risks. Rather than completely removing the board from their position, as we do not have any assurance that the new board will not act in the same way. Required, discuss the problem faced by company A in the context of financial management concepts. Number 2, explain the viewpoint of Fernando. Explain 3 strategies to manage the situations of company A. So what is it about? Can somebody to get started, can somebody give some hints and clues, please? Yes. Okay, good. Others? Others? Okay. Right. So this is governance related problem, and this is not a unique problem in the company. This is what is seen almost everywhere, and there will be conflict of interest between the owners of the company and the people and those charged with the governance of the company. To make a long story short, conflict of interest between the directors of the company and the shareholders of the company. And the shareholders have the objective set, and that is what the directors are supposed to work for. The shareholders have invested money in the company just to get the maximum out of it and to maximize their shareholders' wealth. So all the directors must take the decisions in the company in such a way that they are working towards maximizing the shareholders' wealth and not to prioritize their interest. So they cannot keep their interest ahead of the interest of the shareholders. Why? They are paid by the shareholders. They are paid by the shareholders not for prioritizing their interest, but for prioritizing the interest of the shareholders. So this is called fiduciary duties. Fiduciary duties. And when the directors are appointed, they are acting as agents of the shareholders. So they have the interest, they have the duty. What duty do we call it? Fiduciary duties. That is to work towards the achievement and pursuing the objectives of the shareholders, and not to look after, not to cherish, not to pamper their own interest. So there can be conflict of interest at number of occasions. That is because we know even the directors have their objectives. What are their objectives? Just to maximize their benefits. So in the process of trying to maximize the benefit for shareholders, they have to compromise the interest of the shareholders. Why? You cannot do both together. You can, but the way they have done is completely wrong. Directors are trying to maximize their benefits, and then they need to compromise their duty of maximizing the shareholders' wealth. So they have two different set of objectives, and the shareholders want to maximize their wealth, directors want to maximize their benefits. When the directors want to maximize their benefits, to some extent the shareholders have to compromise their objective. So that is why we will implement different strategies in companies, like implementing employee share option plans, and the directors will be set on performance-based payments, and there will be sound and strong internal control systems and governance structures. So that is why we implement those, just to align these two objects together, so that there will not be a clash and a conflict between the objectives of the directors and the objectives of the shareholders. So this is where the problem is now. The company is owned by the shareholders, and they have assigned their duties to the directors to act on their behalf. So that is why this problem arises. What has happened here? Now the directors want to maximize their benefits. Just to maximize the benefits, they will be tempted to start projects which will be profitable in the short run within the first few years, but these projects will create massive losses to the company in the long run. So the directors are not that far-sighted. They don't want them to be that far-sighted. Why? So they want to make profits. They want to make more benefits for themselves within the short run and not in the long run. Sometimes they might not work for more than 3-4 years. So they don't mind the company losing in the long run. So they will just look at the short-term profits. They are not damn care about the projects that they are going to take over making losses in the long run. After 2-3 years, the projects will be at massive losses. So the directors will not be damn care about it. Why? Then by the time the projects will start making losses, they have collected their benefits and gone. Good. And then it looks like these directors and the shareholders are not listening properly. Why? If the directors take a decision to start up projects which will be profitable in the short run but will not be profitable in the long run, if the shareholders have scrutinized properly the decisions taken by the directors, the fact that these projects will not be profitable in the long run would have been detected by the shareholders. So someone appointed by the shareholders on behalf of shareholders. It has not been detected. Okay, ne? And then there will be agency cost. What is agency cost? On behalf of shareholders, you need to appoint independent outside parties just to monitor the work of the directors. And you need to appoint outside independent parties just to ensure that the work done by the directors will come under the purview of someone outside independent party. For example, auditors. And that agency cost will be high. Agency cost will be high. So that along is not only that's not the only agency cost, and there will be some other costs. So what do we write here as part of your answer? This is a very obvious question, obvious problem. When the shareholders assign their duties and tasks to another set of people called directors, the clashes and contradictions between the objectives of directors and the objectives of shareholders are likely. So the directors are tempted to prioritize their own interest without keeping the objectives of shareholders ahead of their objectives. That is unique. So that is common, not unique, that is common. That is what is happening almost everywhere. So that is what has happened in this company as well. So the directors have tried to maximize their benefits. How have they tried to maximize their benefits? And they have increased their salaries by 50%. And it was justified by saying that it was an inflationary adjustment. So the shareholders need to look into the fact that whether the inflation has been 20% in the year in which they have got the salary increment. If it is all right. I don't think the inflation was 50% in the year in which the directors got their salary increment. No, it was not. And starting up projects whose returns are so impressive and attractive within the short run and are very negative in the long run. So those are the issues where the objectives of the shareholders were kept behind the objectives of directors. So that is where the objectives and the interest of the directors were kept ahead of the interest and the objectives of shareholders. So that is where the directors have prioritized their interest and objectives without prioritizing the interest and the objectives of shareholders. Okay, understood? Okay. Now you want me to dictate the answers or need not? Hurry up. You all want me to dictate the answers or you can help yourself? Take down. The problem in APLC, is governance related problem. Governance related problem. Governance related problem. Which is connected to agency issue. Agency issue. Agency issue. This is a common issue in companies where the shareholders delegate their powers to agents within brackets, directors to act on behalf of shareholders. Directors and shareholders have their own interest and objectives, to be pursued. Directors and shareholders have their own interests and objectives to be pursued. Directors are bound by fiduciary duties, which means the objectives and interest of shareholders should be kept ahead of their own interest and objectives. New line. The way the directors have acted is a clear demonstration of breach of fiduciary duties due to the following. First, by increasing the salaries of directors by 50%, despite of net losses for the last 2 quarters. Next one, implementing work from home concessionary decisions Next one, accepting risky projects. New line, the key features of the problem are first one, lack of goal congruence. Second, shareholders and directors not been properly shareholders and directors not been properly licensed. Next one, incurring agency cost. Incurring agency cost, right. Moving on to second part of the question, explain the viewpoint of Fernando. So what does Fernando say? Alternatively, Fernando, one of the shareholders of A, expressed his viewpoint as follows. This is not a situation unique just for company A. There are many other ways to manage these risks rather than completely removing the board from their positions, as we do not have any assurance that the new board will not act in the same way. Now, some of the shareholders are under the impression that they need to remove all the existing directors and to appoint a new set of directors anew. So Fernando, who is a shareholder, is under a different impressions and an opinion. He says, no, that's not the way, because we can't expect the new set of directors not to work in the same way. Why? All the directors are bloody rogues in the industry. All the directors are bloody rogues in the industry. Okay? Now you can't expect anyone to be clear. So you can't expect these new directors to be appointed to be otherwise. They will also come and do the same thing. So without trying to, and sometimes the company is a highly technical company and the directors need to be knowledgeable. You need skilled people in the director board. You need knowledgeable people in the board. So finding those people in that caliber will be little harder. So as a result, even if you take new set of people, you can't expect them to be perfect people, not to play out. So they also will play out. It's only just that you need to have a chance. You know, a lot of students share our videos. They are going to be chartered accountants. They are going to be bloody rogues. Or they take videos from someone else. Bloody rogues. Okay? Bloody rogues. So you only have to have a chance. If you get a chance, you will do it. You will start doing all dirty things. It's only just that the people do not get a chance. Even if you get a chance, you will do that. So likewise the directors, yeah, they do it. 2-3 people get together and buy the videos, we know, and we have also the details. They do that. They copy it and sell. They do that. So if the market is 200 students, actually people who are watching the videos are not 200, it's more than that. It's like, 200, 300, 400. They are 400. Okay, that happens. Now, what is the solution? What is the solution? So we need to have different set of solutions and remedies. What are the remedies available? Can somebody share something? Yes. Hurry up. Conduct periodic audits. Anything else? Implement risk management. Anything else? Board balance. Anything else? Anything else? All these are correct. We'll take down implementation remuneration committee with non-executive directors. Okay. Right. We'll take down and also we'll discuss. Take down. The viewpoint of Fernando is acceptable. As it cannot be expected the new set of directors, to be free from frauds, pilferages, 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 and cannot be expected to be perfect. Above all, the directors are likely of being competitors if they will be completely removed from the company. And the directors may require technical skills and knowledge to run the company. Therefore, the issue can be sorted as given below without removing the directors completely from the company. First one, goal congruence. Under that, take down the objectives of directors and shareholders. Objectives of directors and shareholders. Objectives of directors and shareholders should be aligned properly. Should be aligned properly. Examples: performance-based remuneration. Performance-based remuneration. Performance-based remuneration. Next one. Employee stock option plan. Employee stock option plan. Employee stock option plan. Employee stock option plan. Next one. Clawback provision. CLAW, clawback, BACK, back provision. Clawback provision. Put a small dash and say this is where the company retains the right. The company retains the right to recall the benefits of directors. Recall the benefits of the directors in the event of the directors breaching fiduciary duties. Is that part clear? Is it clear? Next one. Scrutinizing and reviewing. Scrutinizing and reviewing the work of directors. Scrutinizing and reviewing the work of directors. Scrutinizing and reviewing the work of directors. Under that, take down. Strengthening governance. Strengthening governance by appointing independent directors who should review and monitor the executive directors. Who should review and monitor executive directors. Next one. Independent external audits. Independent external audits. Independent external audits. Next one. Tightening internal controls not to leave room for any Misappropriations or mismanagement. Misappropriation or mismanagement. Next one. Accountability and transparency. Accountability and transparency. Accountability and transparency. Under that, take down strengthening reporting framework. Developing and strengthening professional and business ethics. Next one, say risk management. So that is enough. Okay. Moving on to second part of the question number 2. Oh, there's another one. Eh? Explain the viewpoint of Fernando. We have done it. Explain 3 strategies to manage the situation. I think I have answered that part also, please. I have answered part 2, part 3 also together with part B, second part. Okay, we are moving on to part B of the question. It was clear, I think. I have answered both parts together. Fernando's viewpoint, and then explain 3 strategies to manage the situations of company. So what you just completed, writing down right now, was the answer for part 3, and before that we have completed the answer for second part. That is explaining the viewpoint of Fernando. Are you all okay? Is it clear? Not clear there? Right. Moving on to part B of the question. Sunrisers Hotels Private Limited is one of the prominent hotel chains in Sri Lanka. Currently, SHL is looking into an investment proposal offered by Golden Investments. SHL has the following objectives with regard to the above proposed investment. Objectives: SHL expects to receive 7 million LKR per month for 20 years starting 30 years from now. SHL wishes to expand one of its hotels in Kandy in 10 years at an estimated cost of LKR 100 million. At the end of 20 years of receiving LKR 7 million per month per objective 1 above, SHL expects another 300 million LKR from this investment as the final receipt. According to GI, SHL must invest LKR 500,000 per month for the next 10 years in an investment fund, a part of which could then be used to cover the estimated cost of LKR 100 million required for the expansion of one of its hotels in Kandy. The effective interest rate for the first 30 years is 12% per annum, and the effective interest rate for the next 20 years is 9% per annum. Required: you have been appointed as the Chief Financial Officer of SHL and are required to analyze how much is required to be invested per month between year 11 to year 30 to achieve all these above objectives from this investment. Just read the question again for yourself and see what we are supposed to do, and tell me which topic or which lesson, which topic of the syllabus the question has been set from. Is the question clear? Yes, the question has been from time value of money. Find the future value of 500,000, annuity of year 10. Calculate the balance after utilizing 100 billion for the expansion. Compound the above till year 30A. Discount the lump sum payment of 7 million to year 30. Calculate the annuity figure by taking the difference between A and B. That looks all right, and this seems to be the hardest part of the paper. It was given from time value of money though. All the other questions are pretty easy. If someone has got stuck at the exam, that is only in this part of the paper. We'll try to make it clear. If the question, I don't think the question is strongly worded. That is the weakness of the question. I mean, if the question is strongly worded, doing the question is not that hard. We'll see. Sunrise Hotels Private Limited is one of the prominent hotel chains in Sri Lanka. Currently, SHL is looking into an investment proposal offered by Golden Investments. SHL has the following objectives with regard to the above proposed investment. SHL expects to receive 7 million per month for 20 years starting 30 years from now. So they talk about a very long period, prolonged period. So they expect 7 million rupees per month for 20 years. And this will be 20 years period. But this 20 years will be starting from 30 years now. So this is now, and you need to count 30 years ahead. So this 20 years will be commencing from where 30 years ends. So altogether at a stretch they talk about 50-year period. So this company is expecting to receive 7 million rupees per month. 7 million per month. SHL wishes to expand one of its hotels in Kandy in 10 years at an estimated cost of 100 million. So they are planning to put up a new hotel in 10 years time from now with a cost of 100 million. They are planning to put up a new hotel in 10 years from now with a cost of 100 million rupees. With a cost of 100 million rupees. Okay, right. So that is to happen in 10 years from time from now. At the end of 20 years of receiving 7 million per month per objective 1, SHL expects another 300 million from this investment as the final receipt. That seems to be like the residual value or scrap value, 300 million, that is supposed to happen right at the end. At a stretch you need to count 50 years, so that 300 million will be expected in 50 years time from today. According to GISHL must invest 500,000 rupees per month for the next 10 years. So they need to keep investing 500,000 rupees per month for the next 10 years. For the next 10 years in an investment fund, a part of which could be used to cover the estimated cost of 100 million. Now the company has to keep investing 500,000 rupees a month and let it to be any amount. Let's say that will become 150 million rupees with interest. Then of that maturity value of 150 million, 100 million will be utilized for the construction of their proposed hotel in 10 years time from today. Can you write? The effective interest rate for the first 30 years. Effective interest rate for the first 30 years. Effective interest rate for the first 30 years is given how much? 12%. And effective interest rate for the second 20 years is also given. How much is it? 9%. 9%. You are required to, you have been appointed as the Chief Financial Officer of SHL and are required to analyze how much is required to be invested per month between 11 years to 30 years to achieve all the above projections from this investment. Okay. Now, you will keep investing 500,000 rupees a month over the first 10 years. From the maturity proceeds, we are using 100 million rupees. And whatever that will be left out, let's say we will expect 150 million, we do not know, let's work it out and see. And 50 million will be further kept invested. From this point to this point will be kept invested. And then that investment plus you need to make some more investments here. So that is what is needed to be ultimately calculated. That remaining investment plus whatever additional investments to be made from the 11th year to the 30th year should be adequate in a way that we can draw 7 million rupees a month over the last 20 years time. In other words, you need to keep investing 500,000 rupees over the first 10 years so that you can utilize 100 million rupees for the new project, new hotel, and whatever that will be left out after utilizing for the hotel construction will be further kept invested. In addition to that, you will start investing some more money. That value is not given. That is what we are supposed to work out. They all should be ultimately equal for what? Equal for this maturity value in 30 years time, so that you can keep drawing 7 million rupees per month over the last 20 years time. Last 20 years time. So that is what they want us to calculate. So is the question clear now? Is the question clear? Okay. Now, effective interest rates are given, so you need to convert them into annual rates. What is the rate? What is the formula? Effective, if effective interest rate is given, you calculate periodic rate. Periodic rate. N to the root of 1 plus EAR minus 1. I hope you know what effective rate is and what periodic rate is. If you do not know, just let me know, we can do a small reminding. So where the effective rate is given, you need to convert that into periodic rate, and this is the formula we can use to calculate periodic rate. Okay, right. This is annual effective rate, and what do they say? Effective interest rate for the first 30 years is 12% per annum, and effective interest rate for the next 20 years is 9% per annum. Okay. And they are going to make investments monthly. Monthly. They would have worked out monthly compounding. Then let me take 12 to the root of 1.12 minus 1, and for the second to the last 20 years, again 12 to the root of 1.09 minus 1. So you can work out periodic rates. We'll work out periodic rates. 12 to the root of 1.12 minus 1. We'll multiply it by 12. So periodic rate is 11.38 per annum. Per annum. This one 12 to the root 1.09 minus 1 into 12. Annual periodic rate here has to be 8.648 per annum. Annual periodic rate. Okay. Let me take the first one here. This company will keep investing 500,000 rupees per month over 10 years time, and let's work out the maturity value in 10 years time from now. So what are we to calculate? We need to calculate the future value of a present annuity, or we need to calculate the present value of a future annuity. So I want to calculate the maturity value of the investments to be made within the first 10 years. What are we to calculate? Future value of a present annuity or the present value of a future annuity? Hurry up. Hurry up. At least Udari, Tarendu. $11.38 in නැත්තේ එනවනේ. එනවනේ උදාරි. ඔව් හරි. ඒක එන්නේ monthly නේ. ඒක වැඩි කරන්න ඕන 12 වලින්. එතකොට තමයි annual rate එක එන්නේ. බලන්න. එනවාද? Okay. So what are we to first calculate? Future value of a present annuity or present value of a future annuity? Future value of the present annuity. Let's calculate. 500,000 into 1.1 plus R. R, now we are given the annual rate. This is divided by 12. Why do we divide it by 12? Because we are going to contribute to the annuity scheme monthly. Okay? So that is to be multiplied by N. N has to be once again not the number of years, number of installments. So you must take the number of installments over 10 years time. Number of installments over 10 years time. So that is 10 years into 12 minus 1 divided by R. R is given rate is annual rate. This is to be taken monthly. To be taken monthly, 12. So it's not that hard. So 500,000 into R is 11.3. Let me divide it by 12 to get monthly interest rate because we keep investing monthly. 11.38 divided by 12 divided by 100. So it has to be 1.00948.3 okay, into 120 to the power 120 minus 1 divided by 0.009483. So that will give you the maturity value in 10 years time of an annuity where you keep investing 500,000 rupees monthly. So you will get 110 million 920,078. Does it come? Does it come? Hurry up. Okay. So you will be collecting 110 million rupees in 10 years time as a result of you developing the habit to keep investing 500,000 rupees a month, and then you will be using how much? Minus required amounts. Required amounts for the proposed hotel project in 10 years time. Now it is 100 million. So So that amount will be deducted. So how much will be left out now? 10,920,078. So that amount will be 10,920,007. So that amount will be further kept invested over another how many years time? Over another 20 years time. So let me work out its future value. Future value of the remaining 10,920,078. Now to calculate the future value of that remaining value, you need to take the formula where you calculate the future value of a single cash flow. Future value into 1 plus R to the power n. So let me take for the next 20 years, effective annual rate is 12% to the power 20. That becomes 105,338,271. So this value will be available. It becomes this much, 105,338,271. So that is the value that you will expect in 30 years time after also giving 100 million rupees to the new project. Okay, right. That will be there. Then you want to take 7 million rupees per month over 20 years time. So 7 million is the present value of an annuity or the future value of that annuity. 7 million seems to be the present value of the annuity or future value of the annuity. At least Udari, please answer. Tarindu. A lot of people are there but no one talks. That is the future value, good. We'll calculate the present value of that annuity. We'll calculate present value of that annuity. What is the formula we use to calculate the present value of an annuity? It is 1 minus 1 plus R to the power minus n divided by R. So once again, 1 minus 1 plus R to be divided by 12 to the power minus n. Number of years has to be number of installments now. It has to be n into number of installments divided by R. R has to be divided by number of months. So that's not hard. It's not hard. So the rate for the second 20 years will be different. 1 minus 1 plus R is, we calculated periodic rate for the second 20 years, 8.648. 8.648 divided by 12 divided by 100. It has to be 1.007206. How many years? 20 years. How many months? 12 months a year. Minus 240 to the power minus 240 divided by 0.007206. So this is to be multiplied by 7 million rupees. 7 million rupees. So you will get present value. Present value will be 798 million 055 554 554. So that will be available. So that is the requirement. So you need to have this amount of money. This amount of money for you to keep withdrawing 7 million rupees per month over 20 years time. 20 years time. 20 years time, you must make sure that this amount will be available here. Already you have how much? Say amounts available. Amounts available. Already we have 105 million 338 271 minus. Also we will expect 300 million at maturity in 50 years time from today. You can convert it into present value. Take it here, discount it using the interest rate for how many years? 20 years time. Even that has to be taken here. Say present value of the scrap or residual value, that is 300 million divided by 1.09 to the power 20, sorry, to the power 240. No, it has to be 20. Why I have taken annual rate? Annual rate. Then we take only the number of years. 300 million divided by 1.09 to the power 20. Another 53 million will be available. 53 million 529 267. Deduct it also. So what is the balance? What balance is needed? 798,055 554 minus 105 million 338 271 minus 53 million 529 267. So you must have another 639 million 188 016. So this is what you need to find. So that is the balance, that is the difference. So that is the gap to be bridged. I have made a small mistake here. Not that there will be a scrap value of 300 million. The question says they expect 300 million at once. So they want another return and a receipt. This is the expectations. Not that we get it from somewhere. And it's a different wrong interpretation, please. So actually, this 53 million should be another expectation. 53,529,267. Okay, present value of 300 million. Then altogether they must have how much? What is the balance? Balance to be bridged. The total requirement should be 746, 246, 544. So that is the deficit. There will be a deficit of 746,000, 246, 544. This is the future value that you need to keep collecting over 20 years time from here to here. Okay. So you need to collect that 746 million. You need to collect that 746 million starting from the 10th year to the 30th year over 20 years time. To calculate the value needed, you need to divide this 746, 246, 546 or 544 by the annuity factor. By the annuity factor. What is the annuity factor? The annuity factor to be taken should be the annuity factor that gives you the future value of the present annuity. Future value of the present annuity 1 plus R to the power n minus 1 divided by R. R has to be again here monthly rate. It is 746, 246, 544 divided by 1 plus R. R has to be 12% per annum, and we must take monthly rate. We have already taken the monthly rate before. 1.009483 to the power 240, 20 years into 12, minus 1 divided by 0.009483, and that will give you the amount to be invested within the 20-year period starting from 10 years from now. 1.009483 to the power 240 minus 1 divided by 0.009483. 746, 246, 544 divided by the annuity factor. The requirement for a month is how much? 819,720. This is what you need to keep investing within the 20 years time, 20 years time from 10 years time from today. Right. So that is what the examiner has been asking. I don't know whether you all did it right at the exam last time, if you did the exam last time. Okay, ne? Don't know how clear it was. That is bit of a tricky questions and an example, and that is the hardest part in the paper. All the others are very simple. Is it okay? Where the effective rates are given, you need to first work out periodic rate. Okay, ne? Fine. So we'll take fine. So we'll take just a small break for lunch, and then we'll go to question number 3. Are you all there? Right. We'll go to question number 3. The shareholders of 𝐿𝐼 Logistics PLC recently expressed growing concern over the company's declining profitability and the corresponding drop in share price in the stock market. In response to these pressing issues, the board of directors has recognized the necessity of implementing a strategic initiative to reverse the trend and restore the share price. The board of directors of 𝐿P decided to pursue the acquisitions of the 25% stake in Ocean Shipping Line Private Limited from its warning shareholders in a strategic move to capitalize on synergies between complementary logistic operations. This acquisition aims to unite 𝐿P freight forwarding expertise with OSL's capabilities as a non-vessel operating common carrier, creating a robust integrated logistic solution. To facilitate this acquisition, 𝐿P plans to issue new shares at the current market price of ₹200 per share, thereby expanding its equity base while leveraging the combined strengths of both companies to drive future growth and enhance market competitiveness. Negotiations with these two shareholders, the 25%, have successfully concluded, with an agreement reached for the acquisitions of their total equity capital at a price of rupees 11,287 million. The acquisition of OSL is projected to deliver substantial financial benefits through synergies. The projected present value of the synergetic benefit resulting from the integration of ELP and OSL is expected to be rupees 25,000 million. However, the acquisition would incur one-time cost of rupees 3,850 million. The weighted average cost of capital for the combined entity has been calculated as 15%, which closely matches the WACC of each individual companies prior to the acquisition, which closely matches to the WACC of each individual companies prior to the acquisition. So that part is important. The following additional forecast information is provided for both companies to facilitate the calculations of their respective market values. Ecom Logistics PLC, earnings before interest and tax, finance cost, depreciation included, amortization included, change in working capital, capital expenditure. Ocean Shipping Lines Private Limited, free cash flows given. Assume that the free cash flows after tax of ELP will stay constant at the levels reported as at 31st March 2026, while OSL free cash flows will grow at a rate of 5% per annum from 26 to 27 onwards. The corporate income tax rate is 30% per annum. Required write a memo to the shareholders of ELP as the financial expert to the board assessing whether the strategic initiative to acquire OSL would effectively address the concerns of the shareholders. Support to answer with anticipated synergies, immediate financial gain, current profitability challenge, and stabilizations of the share price along with an independent calculations of the post-acquisition share price. Explain 3 potential risks that need to be carefully considered by ELP's shareholders before proceeding with the acquisition. So I will only perform the calculations. Memo writing, you can help yourself, and it's kind of a, letter writing, that's not that hard. So what matters the most is what? To calculate the values. Now, in the pre-scene, the company that they speak the most about is ELP. So they are going to acquire 25% of Ocean Lanka Shipping, which is another company operating in the same industry. So they are planning to pay how much? They are planning to pay at a price of 11,287 million. It's just that you need to make calculations to see whether it is worth paying that value or it's not worth paying that value. So if the value of this company will be less than 11,287, let's see. Okay, and it's all about whether this payment is worth or it's not worth, whether it's going to be a win-win situation. So especially from the perspective of ELP, from their perspective, whether it is worthwhile. So this acquisition is not a harder part of the question, and you need to also calculate the synergy benefit. To calculate the synergy benefit, you need to separately value ELP, separately value OSL, and then you need to separately value the combined company. Here, to calculate the value of the combined company, you need to take the value of ESL, OSL, and then value of ELP, add them together, and then you will get the total value of the combined company. Right. We'll first go to valuation of ELP. ELP valuation. ELP valuation. Just for 2 years they have given us earnings before interest and tax. This is 24, 25, 25 and 26. Earnings before interest and tax 32,837, 35,135. Will deduct taxation. Will deduct taxation. Can somebody tell me the tax is given 30%. Tax is 30%. 32,837 into 30%. 9851. 35,135 into 30%. It is 10,541. We'll take earnings after tax. $22,986. Next year, 135 minus 10,541. 24,594. Then we'll add depreciation and amortization. Depreciation given 858, 856 plus amortization. Amortization 102, 102. Then the cash flows will be 23,946 in the first year, second year 25,552. Minus capital expenditure minus working capital changes. Capital expenditure here 943, here 942. Changes in working capital inflow, that is an inflow. 289 should be added, 222 should be added. 23,946 minus 943 plus 289. 23,292. This is 24,832. 24,832. Right. So before we discount, we'll take the terminal value. The cash flows of ALP will stay constant at the levels reported. Okay. We will expect the same cash flow to continue to the perpetuity, 24,832. Then what are the discounting rates? Now they have given the WACC for the combined company. Having said that, the examiner continues to say that the individual WACC of ELP and OSL are also equal to 15%. So this 15% common WACC rate can be used to calculate the market value of both companies and also the combined company. I hope you got that point. Will discount it by 1.15, 1.15 to the power 2. This is discounted by first by 0.15 discounted then by 1.15 to the power 2. 23,292 by 1.15. 20,254. 24,832 by 1.15 squared. 18,777 plus 24,832 divided by 0.15 divided by 1.15 to the power 2. 125,177, that is the terminal value, plus 18,777 plus 20,254. Enterprise value or the firm value. Enterprise value is 164,208. 164,208. Okay, ne? And you know, this is not the final figure. Some adjustments are needed. What are the adjustments to be incorporated? Just have a look at the balance sheet of ELP in the pre-C. ELP. Okay. So you need to add cash and cash equivalent of 40,656. Okay, ne? What else? So we have taken earnings before interest and tax. Earnings before interest and tax. If they have taken earnings before interest and tax, it's not the operating cash flow. Earnings before interest and tax, what does it say? They would have taken other incomes as well. Interest income, dividend income. So that depends on your assumption, please. You can have a solid answer because some information is not clearly given. Okay, now it says earnings before interest and tax. The examiner does not specify whether they have included, other income like interest income, dividend income, and so on and so forth. Then only you can decide what to further add and what not to be added. So we basically have to include cash and cash equivalents, and you need to deduct what? Deduct borrowing. Borrowings need to be deducted. Borrowings, assuming that they have taken what? Into earnings before interest and tax calculation. I reasonably assume that you can indicate as part of your answer if you want. I reasonably assume that they would have included other income, dividend income, interest income, so that financial assets are already included into these valuations. We have discussed them in the theory class. Need not to get into details. If you were in my theory classes, it was logically explained. Now let me take as a result cash and cash equivalent. Cash and cash equivalent. How much? 40,656. Need to deduct debt. Debt should be how much? Debts under non-current liabilities, 16,741. What else? Under current liabilities, 15,062. It is 31,803. 31,803. So we'll take the value. $173,061. 173,061. Then we'll go to the valuation of OSL. So that's even easier than the previous one. Valuation of OSL. We are given the cash flows, not the cash flows, they have given us earnings before. No, they have given the cash flows, thanks God. Examiner has been very kind and generous. He has given us cash flows, not the earnings. 24 and 25, and this is 25 and 26. This is 2,299. This is 2,759. And even the cost of capital of OSL is considered to be equal to 15%. So you need not to work out any WACC. Discounted by 1.15, 1.15 squared. And these cash flows expected to rise by 5%. So we will take the terminal value. So let me take the total here, 2,299 by 1.15. It is 1,999 plus 2759 divided by 1.15 to the power 2. 2086. We'll take the total 2086 plus 1,999. It is 4,085. Plus terminal value. Terminal value 2,759 into 1.05 divided by 0.15 minus 0.05 divided by 1.15 to the power 2. 2759 into 1.05 divided by 0.15 minus 0.05 divided by 1.15 squared, 21,905. Take the total 0, this is 25,909. So this has to be the enterprise value. Enterprise value. So once again, to calculate the value of equity, you need to do these required adjustments. We'll see what the required adjustments are. Take cash and cash equivalents. OSL. Okay. Cash and cash equivalent. $1,602 minus debt. Long-term borrowings. Long-term borrowings 5,500 long-term borrowings, plus they have short-term borrowings of 1,677. That is 7,177. 7,177. Take the total 25,990 plus 1,602 minus 7,177. It is 20,450. Value of equity. Value of equity. Right. Now we'll take the value of the combined company. Value of the combined company. equity value of the combined company will take equity value of ELP 173061 equity value of OSL 20,415 and they expect a synergy benefit. What synergy do they expect? The question says they expect a synergy of 25,000 synergy benefit. Minus they need to incur a cost to get these two companies combined. What cost is needed to get this done? 3,850. So that has to be the value of the combined company. 173061 plus 20,415 plus 25,000 minus 3850. Equity value of the combined company. $214,626. 214,626. Out the number of shares of ELP in issue, please. Can somebody find me the number of shares of ELP in issue? Number of shares in issue, please. Can somebody find me? 500 million. How did you get it? Using EPS. Okay, EPS is given. Okay, 500 million. Right, it's 500 million, yes. So requirement is write a memo to the shareholders of ELP as the financial experts to the board assessing whether the strategic initiative to acquire OSL would effectively address the concerns of the shareholders, support your answer with anticipated synergies, immediate financial plan, financial gain, current profitability, challenge and stabilizations of the share price, along with an independent calculations of the post-acquisition share price. Okay. So now we are now issuing new shares. Company has already 500 million shares in issue. And for this synergy benefit, you need to issue some more shares. Number of shares in issue, $500 million. So the company will be planning to issue, settle how much? Second paragraph in the question paper says, the last line, last sentence. Negotiations with these two shareholders successfully concluded with an agreement reached for the acquisitions of the total equity capital at a price of 11,287. So we need to settle 11,287 million. 11,287 million. So the number of shares to be issued to settle 11,287. 11,287 should be settled by issuing shares, and what is the value of a share to be issued in settlement of 11,287? And the current market price is 200. So we will divide this 11,287 by 200. Then you can calculate the new shares to be issued. 11,287 divided by 200. That should be another 56 million. Total will be 556. Total shares will be 556. And then you can calculate the new value per share. We'll calculate the new value per share. $214,626 divided by 556. 214,626 divided by 556. That will be 386. So the current market price is 200. We expect that to increase to 386. 386. Now, what is your recommendation to the director board? The acquisition seems to be a good strategic initiative. Why? So there will be synergy benefit of altogether. Synergy benefit was added. Synergy benefit was altogether 25,000. And we expect the market price to increase almost by 100%. Now the price is 200. We expect the price to become 386 after the synergy. I mean after the acquisition, after the integration, after the merge. After the merge. Okay. So therefore it is recommended that they need to move ahead with the acquisition. So you can complete the memo writing part. I will just leave it for you. Part B, explain 3 potential risks that need to be carefully considered by ELP shareholders before proceeding with the acquisition. Okay. So we have studied that in the theory class. There can be a lot of risks. These risks will arise in different forms. Some risks will be related to operations, and some risks will be related to finance and the capital structure. And some risks will be based on market and competitions. So you can just list down so many risks. I'll just discuss and you can help yourself. Operation will be affected after the integration. Why? Now for this synergy to be realized, 25,000 synergy to be materialized, all what has to happen in the future after the integration should be exactly similar to what we expected. Your expectations are so much, and for this 25,000 worth of synergies to be materialized, all what has to happen subsequent to the merge should be exactly similar to what we thought would happen after the acquisition. Okay, so there can be revenue synergies, there can be cost synergies, there can be finance synergies. They all should be exactly similar to what we expected at the beginning. If not, you will not expect. Now, after merge or the integration only, sometimes you will understand and realize what this company is all about in the real sense of the word. Okay, you had not studied this company properly. The information you collected before the merger was different. Now only the scales fell out of the face, and now only their true reality will be unfolded in front of you. Now only you understand how good this company is or how bad this company is. So there can be, cultural clashes. So as a result, this integration will be impeded. This integration will be hindered. The integration will be blocked because these two companies have two different cultures. These cultures cannot be integrated together. Or else there can be temporary disruptions. There can be operationally, there can be disruptions. Say for an example, the salary scales of one company can be higher and the salary scales of the other company can be lower. So all of a sudden you can't bring them to a common scale, so that will take little time. So the people who are paid less will be little disruptive, so that will slow down the progress of the company. And you need to have kind of a post-acquisition audit. How realistic this synergy was, whether we are realizing that synergy the way we expected. Okay, now the capital structure will not be the same after the acquisition. There will be changes in the capital structure why these two companies will be merged together. So OSL will have a different capital structure, and the other company ELP will have a different capital structure. So when these two capital structures will be merged together, so there can be problems to the operations. Okay, so likewise you can list down so many risks and they are asking only 3. Is that okay? I'm just rushing through because I want to finish it by 3 o'clock. Is that all right? What matters the most is the calculations. Once you complete that, you can answer. Okay. Moving on to the next part of the question, SLP plans to set up a foreign warehouse as part of its expansion strategy in the Australian region. The company has begun negotiations with the Australian government to acquire a property owned by them for a total purchase price of 10 million Australian dollars. A memorandum of understanding has been signed between the parties. ELP has already incorporated a company in Australia as an affiliated entity to facilitate this expansion. To finance the above payment, ELP has 2 financing options. Option 1, payment plan proposed by the seller. According to the memorandum of understanding signed with the Australian government, ELP is required to make payments for the property as follows. 25% of the total purchase price is payable immediately. 50% of the remaining balance is due in 1 year, along with 6% interest per annum on the amount outstanding at the beginning of year 1. The final 50% of the remaining balance capital is due in 2 years, along with 6% interest per annum on the amount outstanding at the beginning of year 2. ELP will have to follow the above payment schedule outlined by the Australian government. However, the government requires a bank guarantee for payments due in year 1 and year 2. The bank charges 0.75% per annum on the guaranteed payment to be made each year as the fee for providing the guarantee. Option number 2, permanent overdraft facility in US dollars. ELP could obtain a USD overdraft facility for the purchase price of Australian dollar 10 million at a concessionary interest rate of 0.5% per annum for a period of 3 years, which will be backed by a USD fixed deposit held by ELP in Sri Lanka for the equivalent amount. In this case, the USD fixed deposit, which pays 6% compound interest per annum USD at the end of each year, will not earn interest for the durations of overdraft facility. Additional information: ELP's earnings in Australia will be generated in Australian dollars. Current exchange rate is 1 USD is equal to 1.5 Australian dollars. Discount rate for ELP's global investment is 15%. The exchange rate for the next 3 years will be as follows. Year 1, 1.575, year 2, 1.670, year 3, 1.753. Required: perform a financial analysis comparing the two options in terms of total present value of the payments ELP would make under each option mentioned in assumption you make. Okay. I think the question may be clear that they are planning to purchase a property in Australia for them to expand their business into a different region. So that will be 10 million Australian dollars. Then they have signed an MOU with the Australian government where ELP has already incorporated a company in Australia as an affiliated entity to facilitate this expansion. To finance the above payment, ELP has two financing options. 25% of the total purchase price is payable immediately. Say immediate payment. Immediate payment should be 2,500,000. %50 of the remaining. So total was 10 million, paid immediately 2.5, so the remaining should be 7.5. 50% of that remaining is 3,750,000. 3,750,000. Second payment, 3,750,000. So the third payment, $3,750,000. And these payments to be made with 6% interest per annum on the amount outstanding at the beginning of year 1. So we need to complete. We'll take years. Year 0, you will pay 2,500,000, and outstanding balance is how much? let me put the total here, total value 10 million payments, say interest payment outstanding balance. So no interest for this payment at year 0, so that was 2.5 million, balance is 7.5 million. End of the first year, outstanding balance is 7.5, and you need to work out 6% interest. 7,500,000 into 6% interest is 450,000. Then capital plus interest need to be paid. Capital should be 50% of 7.5, so that is 3,750,000. 3,750,000 plus 450,000. That is 4,200,000 should be paid. So the outstanding balance should be 3,750,000. $3,750,000, take interest of 6%, 225,000, total payment to be done, 3,975,000. So there is no balance. There is no balance to be paid. So that is how the payments work under the first plan, and they have a cost of capital is how much? 15% cost of capital. Discount rate is 15%. Now, under option 1, there is another charge to be taken. What is it? They are supposed to pay, they are supposed to provide a bank guarantee. The bank guarantee will be imposing another finance charge of how much? Another finance charge of 0.75%. 0.75%. Say bank guarantee charge for the first year payment 3,750,000. The first year payment is 3,750,000 plus 450 into 0.75%. That is another 31,500. 31,500. Then the bank guarantee charge for the second payment, 3,750,000 capital payment plus interest to the second payment is 225 into 0.75%. It's another 29,830. So let's take all the payments now. Year 0, first year in and second year in. Payment at year 0 should be 2.5 million. Second year payment should be 4,200,000 plus bank guarantee charge. That is 4,231,500. Third year payment 3,975,000 interest plus capital plus bank guarantee charge 4,004,813. We'll discount it using 15%, 1.15 to the power 2. So that is also possible, Udarius. So then you need to discount it at 15%. $4,231,500 divided by 1.15. 3,679,565. $3,028,214. So it's altogether 9,207,778. Then the second option. Option number 2. ELP could obtain USD overdraft facility for the purchase price of Australian dollars 10 million at a concessionary interest rate of 0.5% per annum for a period of 3 years, which will be backed by a USD fixed deposit held by ELP in Sri Lanka. For the equivalent amount, in this case the USD fixed deposit, which pays 6% compound interest per annum in USD at the end of each year, will not earn interest for the durations of the overdraft facility. Additional information, ELP's earnings in Australia will be generated in Australian dollars. Current exchange rate is 1.5. Discount rate, ELP's global investment 15%. Okay. They can obtain a US dollars. Now the payment has to be done in Australian dollars. And they can take an USD overdraft facility for the purchase of Australian dollars 10 million. Okay. Requirement is 10 million Australian dollars and they can take an overdraft facility in US dollars at a concessionary rate of 0.5% for 3-year period, which will be backed by a USD fixed deposit held by ELP in Sri Lanka. For the equivalent amount in this case, the USD fixed deposit pays 6% compound interest per annum USD at the end of each year, will not earn interest for the duration. So what? OD facility in US dollars will be equivalent to how much? 10 million divided by the spot rate between US dollars and Australian dollars, 1.5. What value of OD will be needed to cover up 10 million Australian dollars? 10 million divided by 1.5. That is equivalent to 6,666,667. Okay. Then your payments. Your payments to the government in Australia should be paid in Australian dollars. And your payments should be taken from Australian dollar overdraft. How are they paid? I mean, how are the payments to be done? It looks like that you make the payment, the entire 10 million will be paid at once. And you will keep this OD over 3 years' time. So the payment schedule given before is only for option 1, not for option 2. So in the option number 2, it looks like them paying the total amount at once. At once. Okay, ne? And they have given us the exchange rate for another 3 years to come ahead. What is it for? What is it for? Okay. What do you think they have given it for? What is it for? Just to work out maybe to work out interest over 3 years time. Just to work out interest over 3 years time in Australian dollars. Then say year 1, year 2, year 3. $6,666,667 into 0.5% interest. 0.5% interest. It is 33,333. We'll assume that we will settle the bank OD in 3 years time from today. So we need to convert this dollar interest payment into Australian dollar currency. Will convert dollar interest payment into, will convert USD interest payments into Australian dollar currency. So we are given the exchange rate. These are in US dollars. We'll convert that into Australian dollars. 1.575. This is 1.670. This is 1.753. 1.753. 33,333 into 1.575. 52,500. 33,333 into 1.670. 55,666. This is 58,433. 433. Plus also you need to work out interest income that we have foregone. Interest income we have foregone on fixed deposits. Why? The bank has stopped paying interest for the fixed deposit, and that is on compound interest basis. What is the total USD fixed deposit? Equivalent to 6,666,667. That is for 6%. We'll take the interest rate. First year 399,000. We'll take it as 400,000, please. 400,000. Second year 423,000. We'll make it 424,000. Last year 449,430. Right, so we'll add them together. First year foregone fixed deposit interest 400,000. Second year foregone interest 424,000. That has to be converted into dollars. 449,430. We'll convert them into Australian dollars. Australian dollars 1.575, 1.670, 1.753. And then you can discount it and see which one is better. Which one is better. Okay, ne? Right. So with that, let me finish the discussions, and the next part is very simple part. You can do it alone. Based on the financial analysis performed above, discuss 3 qualitative factors ELP should consider in deciding that. You can finish it. You can do it on your own. So we'll conclude our discussions. I think pre-scene was done and the last paper was done. I just ran through a little fast. Anyway, thanks for joining for the live session, and hope you all will pass the exam. Paper this time will be easy, and you need to go through the areas we predicted. So we have another 1 more week. You can get ready. Okay, all the best. Good luck, and hope to see you all at the case study.